Hello, my name is Mike Henderson. I am a retired professor of political economy. Many of you may not be familiar with what political economy is. It is a branch of political science that deals with the complex relationships between governments at all levels in Canada, federal, provincial, and municipal, and their massive bureaucracies and their regulating agencies, the relationship between this amalgam and, in fact, the basic economic structure of Canadian society. So it's a matter of looking at a very large picture, a general picture of how, in fact, our geopolitical system operates. I'm delighted to have this opportunity to present to Canadians a very simple financial idea, which I think would be of great value to a large number of Canadians. It is a financial idea, and therefore I want to proceed very, very slowly and carefully. Because often when you mention financial, people think money, and money rings heavy bells with a lot of people. In fact, the psychology between people and their money, hopefully they have some, is a very, very complex and personal subject. Okay, this idea, which I developed late in the year 2000, I have given this idea to a number of friends, family, and many of them have done extremely well in terms of maximizing their savings safely. And this is absolutely crucial to the idea. Safety, safety, safety of your savings. And after savings, to get considerable growth, greater than the growth of the overall Canadian stock market. I want to present this idea in the simplest way possible, and this means that I have to approach how the idea was conceived. So I have to bore you for just 2 minutes with a small amount of personal history. Retired almost 18 years ago, and in retirement I didn't pay much attention to retirement plan or pension plan. Read all the books. Being an academic, you naturally read the background books, and the consensus view is, in fact it was virtually the only view, was that one should follow the balanced portfolio theory. It is known as the 60-40 theory. If you're in your 50s, say 60% in equities or stocks, 40% in bonds, or perhaps 30% in bonds and 10% in cash to take care of emergencies and all the rest of it. And all it was really entailed was, in fact, to have a professional realign the percentage of stocks to bonds to cash, the balanced package, as you aged, because of course degrees of security change as one gets older and it is out of the workforce without a source of income. I was doing about 65% in equities, using mutual funds, and I had done research, and they were some of the top mutual funds of the day. And I went to a bond fund which had a very good record. The only problem was, after a couple of years, is that we were losing money. So therefore our income dropped. We returned. We had moved out to the West Coast. We returned to Toronto. And it became imperative that I move away from the 60-40 mutual fund plan and come up with the famous Plan B. And I was wondering exactly what to do. We were not living high on the hog, as they say. So I thought, well, there's natural gas is essential to the economy and to the personal comfort of Canadians living east and west of Alberta, Saskatchewan. In the foreseeable future, our industries are going to need oil. Our chemical companies in particular rely heavily on oil. And of course, most of us, because we're not all living right in the core of Toronto, need oil for gasoline and for transportation. So these are essentials. We can't do without them. In the modern industrial society, we just assume that we have an electrical system that works and it's absolutely essential. So if you take oil, gas, electricity, they are critical in providing services for individuals and critical in many ways for the operation of the economy. So then I started thinking past my immediate context, which was this small bungalow, and thinking, what else is really essential in Canada? And of course, the idea struck me immediately. It's almost a cliche that this country has developed on the back of its two major railroads, Canadian Pacific and Canadian National Railroad. The railroads are absolutely essential to the functioning of our economy. I mean, you don't have to think about it long, but farmers have to get their wheat and supplies, canola, whatever, to market. Lumber has to be shipped by a rail, most of it down to the States, and I hope that continues. Miners have to get the ore from the mine site to coast. And the railroads are critical to the operation of the whole economy. There's certain bulk goods that we produce as an economy based in large part on natural resources, even if we're moving manufactured goods like automobiles. It's done in very large part by our railroads. And of course, if we want goods, simple clothing, I mean, it comes in containers in what is called an intermodal service, ships to Vancouver or Montreal, and in fact loaded onto railroads, taken to central depots like Montreal or Toronto, and then put onto trucks and taken to particular merchants. So here we go. We had oil and gas, electricity, our railroads. Now, it's not enough, of course, to simply think of what is essential in terms of our lifestyle and the functioning of our economy. You have to know if there are Canadian dividend-paying securities on the Toronto Stock Exchange which supply these essential services. And if one put their savings into these dividend-paying corporations, could you realize a significant rate of return adequate for your needs? We were not living an auspicious life, but in fact we would need, it became very clear that given the degree of savings we had, we would need much more than the 5 or 6% that is promised by most of the mutual fund companies. So then, being an academic, the research started. And I started with the railroads, and it is a most important variable that I wanted the 10-year total return record. Now, many people are not familiar with the term total return. But total return simply means gain in equity, increase in the price of the security, plus the dividend. You must insist, if you're going to make any decision about an equity or security, to have at least a 10-year record. And the reason is what we call the short business cycle. It's nice to say they've done well in 3 years or 5 years. Means nothing. It's very deceptive because it doesn't give you the overall ongoing strength of a corporation in terms of its strength in the market, the stock market, and in making a profit. If we look back historically, every 6 or 8 years in our market economy, we have a downturn, which some people call a recession, and the economists, a lovely turn of phrase, call it negative growth. Well, usually before negative growth transpires, you have a swoon in the stock market. And a major correction, 15, 20%, is quite normal in the stock market. If we take 3-year figures or 5-year figures now, we have not had a major market correction. Quite the contrary. We've had a very strong market upsurge in the last 5 years. So if someone gives you 5-year data, be very, very cautious, because to look at 5-year data or anything less than 10-year data is very deceptive. So after getting some preliminary figures and having identified the companies, at that point it was 7 companies, I went to the data bank at the Schulich School of Business at York University. And with the help of a very clever librarian, I was able to, in fact, get from the data bank the total return for 6 or 7 companies up to that point. And the results were really quite mind-blowing, to use a popular phrase. They were quite spectacular indeed. So here we go. To make the point, I created in copyright a personal index, the Canadian Essentials Equity Index, which is not an index you'll see in your newspaper. It's simply a personal index. It is, in fact, a personal pension fund. And looking at the 10-year numbers, there are 10 stocks in which you can invest if you make a decision to invest. I am not a financial advisor in any way, shape, or form. I am simply a retired educator. I deal with ideas, I deal with facts. I am not selling anything. 10 companies that I believe, maybe I'm wrong, maybe you think I'm wrong, but 10 companies I believe will give you a return greater than the market, a total return greater than the market, are Canadian Pacific Railway, Canadian National Railway, Canadian Utilities, Emera Corporation, Fortis Inc., which trades under FTS in the market, Enbridge Pipelines, Trans-Canada Pipelines, the Royal Bank, the TD Bank, and the Bank of Nova Scotia. Now, these are not random picks. They are designed for their safety first. And also, if you look at the record, tested by the Great Recession of 08-09, they produce very high returns on your savings. 4.7% over a 10-year period from the overall market. So people who say simply buy the market, and historically, as many very intelligent people have said, the market will always go up. But it's a very jagged saw with great swoons and all the rest of it. And of course, the last really serious swoon we had, as I said, was 08, 09. Okay, let's look at what is in this personalized 10-year Essentials Equity Index. Canadian Pacific Railway and Canadian National Railway. The market over that 10-year period, I keep repeating the figure, 4.7%. Canadian Pacific did 14.40%. 14.40%. And the total compound annual return over 10 years, taken from a US data bank, was 235%, compared with the overall market's 58.3%. Then there's Canadian National Railroad, which many analysts say is the best run railroad in North America. And these two railroads aren't simply Canadian railroads. They are continental railroads. CN in particular can take goods from the Pacific Ocean to the Gulf Coast, the United States, or to the Atlantic Ocean. It runs, both of them, particularly CN, run a very large part of their operations in the United States. So in fact, we have a built-in diversification with the railroads. Now, what proves that they are essential? Well, a farmer who wants to move his goods to market will explain to you why they're essential, but we're not all farmers. It is interesting, in the last 10 years, I believe it was CP twice and CN once, the workers decided to go on strike for better benefits and, in some cases, better wages. Well, in both cases, they were legislated back to work within 1 or 2 days, because the railroads, the Conservative Party under Mr. Harper, and the Liberals agreed that the railroads could not hold the Canadian economy to ransom. This is putting it in very crude terms, but it's terms that everybody understands. People must be able to move their timber, they must be able to move their ore, they must be able to move their goods. They need, and the intermodal service for finished products. So here we have CN 18.51% over that 10-year period for a total compound return of 361%. And what is the risk? They can't stop operations. That's been demonstrated by our federal government. Their service is essential. The government assumes a lot of responsibility for railroad safety. And in fact, after certain disastrous accidents, of course, reducing speeds, changing into new tanks if they're going to transport heavy bitumen from Alberta to the United States, Gulf Coast, or to other deposit points. So try to imagine this country operating without its railroad. It just won't happen, and therefore they are an essential function. And then we look at electricity, and there are a group of companies called utilities. And the three that I chose for this little personal index were Canadian Utilities, CU, as the symbol on the index, works mostly in Alberta But in fact, they have a quite remarkable record of increasing their dividend once or twice a year. Usually, I believe it is in January. And if a company, as John Heinzel explains in his articles, regularly increases its dividend, then you know this is a company that has a solid financial base, that has a predictable future, and if you're supplying natural gas or particularly electricity, you can't simply discontinue service. These utilities at the provincial level are mandated monopolies. They're not in the competitive marketplace. Because once they've established lines to a particular city or industry, no other company is going to come along and go to the enormous capital expense of duplicating lines to a small community in Alberta, or with another one, Emera, which is an Eastern Canadian utility, but it also has considerable interests in Maine, parts of New England, and even in the Caribbean. And there is Fortis, which operates primarily in British Columbia and Alberta, supplying hydroelectric power. It now has considerable interests in a company in Arizona. And the experts in this area say that the rates of return on regulated utilities is in fact slightly higher in the United States than it is in Canada. So they're monopolies, they're indispensable, they're essential. It's as simple as that. So they're safe, or safer than houses. Then there's our two big pipelines, Enbridge and TransCanada Pipeline. Well, these also are not simply Canadian companies, they are continental companies. They all have very large operations, not only in Canada, but also in the United States. And they make their money off tolls. I mean, as long as the natural gas comes, then they have to have their charge for tolls, they have subsystems and all the rest of it. And they are essential, I mean, because they have right of way. Take TransCanada Pipeline. The main line services natural gas to Ontario and to Quebec. And these are essential services. So here again, I'll just very quickly give you numbers. Remember, for the market in this 10-year period, the total compound return was 58.3. Enbridge returned 253%. TransCanada Pipeline returned 124%. The banks in this personal index are the Royal, Toronto-Dominion, and the Bank of Nova Scotia. The Royal is the 10th largest bank in the world. It has interests not only in Canada, but interests in the United States, in Europe. You look at their major portfolio, it is truly a global company. TD has been expanding from Canada into the United States, and now it's actually in a position where there's more branches, retail branches, of the Toronto-Dominion Bank in the United States than there is in Canada. Then the Bank of Nova Scotia I chose not only because it's the third largest, but because it has significant interests in Latin America. In fact, I've read that half the employees of the Bank of Nova Scotia speak Spanish. Now, our large banks, actually all six of them, but these included, have been designated as essential to the operation of the economy, to have a solid base. And their returns are really quite amazing. Just to cut it short, not become repetitive. RY over 10 years, Royal Bank, 190%, TD, 195%, Bank of Nova Scotia, 143%. Now, where does this data come from? I said I would mention the data bank. There is a site in the United States called longtermdata.com, and they have a dividend reinvestment calculator, which is very easy to use. So I've generated this data over a 10-year period, and if you average it out, these 10 essential companies or public corporations have produced a return of 12.655% compounded annually. So that $10,000, which many people in mutual funds can afford, invested equally in these 10 companies, $10,000 would have grown to $32,908.00. And it beats the market hands down, okay? So when my friend in Ottawa said, you know, you big schmuck, I think you have $1 million idea here, he was right. For us, it has been $1 million idea. And I'm pleased to say for other members of the extended family, and I don't know about our friends, we don't discuss money that often, it has been a $1 million idea. But the problem is getting it out. And the best way to do it is the way the millennial generation is dealing with stocks and equities, and that is going through electronic accounts where you can make trades of $10,000, $15,000, $20,000 once you've reached your first $500,000 and want to move on. And it costs you $9.95 to make the trade, or $9.90 with the other company. If you've gone through a broker or you're paying fees, a company, Q-Trade, is now advertising that most people in mutual funds over a period of years in their pension will be paying almost 30% of their capital in fees. And the thing is, this is a buy and hold portfolio. And the beauty of it, the simplicity of it is, there's no need to do research. If you buy the idea that these 10 companies all perform an essential function in providing what people need, in providing what the economy needs, then there's no need to read annual reports or semi-annual reports, to look at balance sheets and all the rest of it. Because they are viable because of their critical functions. We're supposed to say, now discuss this with your friendly financial advisor. And I can tell you what he or she is going to say immediately. Number one criticism: it's not diversified enough. I mean, you haven't got bonds. Well, if you're getting, the last figure I saw on 10-year government bonds, the safest, 1.44%, maybe closer now at 1.5, varies day to day. You're getting the rate of inflation. With inflation, even the Bank of Canada target is 2%. So if you're getting 2% in a bank savings or GIC or bonds, you're getting nothing. Now, these regulated companies, including the banks, which operate under the Bank of Canada, regulators are aware that to be viable, a corporation must be able to expect an acceptable real rate of return. And by real rate of return, they mean a rate of return which includes the cost of living or inflation. Therefore, this is a very, very simple idea. That's why I glory in the phrase, Mr. Blazingly Simple. You know, to make your savings grow safely in a pension plan, you do not need a lot of advice. You don't need an economics degree. You don't need to be a certified financial planner and all the rest of it. And to prove the point, I read in my morning newspaper the other day that in that 10-year period, to March 31st, 2017, less than 10% of the portfolio managers who dealt with Canadian securities managed to beat the overall market or index. And that is truly disgraceful because your savings are being wasted. Well, wasted as far as you're concerned, but in fact, the industry maintains you must diversify to be safe, a whole bunch of different ideas. You can't have security as well as growth. A lot of cliches, but these are all cliches designed to serve the interests of the industry, not of you, the customer. But please, please sit down and do your own thinking. Thank you very much for listening. I appreciate it. Goodbye.